Did you know that a single corporation can have thousands of owners, and none of them ever have to meet each other? That's the wild reality of how corporations work, and it's exactly why corporation accounting is unlike anything else in the business world. In the next 10 minutes, you're going to learn how corporations raise money, how they track ownership, what happens when they share profits, and how to read the equity section of a corporate balance sheet like a pro. Whether you're studying for an exam or just trying to make sense of the financial news, this video is going to make it all click. Let's get into it. Section 1. What makes a corporation different? Before we talk numbers, let's talk structure. A corporation is a legal entity that exists separately from the people who own it. That means the business can enter contracts, own property, and even get sued, all on its own. This is called limited liability, and it's a huge deal for investors. If you buy shares in a corporation and the company goes bankrupt, you only lose what you invested. Your personal savings, your car, your house, all protected. That's very different from a sole proprietorship, where your personal assets are on the line. Corporations also have an indefinite life. If one of the owners dies or sells their shares, the corporation keeps going. Ownership just transfers to someone else. And because ownership is divided into shares of stock, it's incredibly easy to buy in or cash out without disrupting the business. Now here's the thing. All of these features create unique accounting challenges. How do you track ownership when it's constantly changing hands? How do you record profits that belong to thousands of shareholders? That's exactly what corporation accounting solves. Coming up, we'll look at the very first step, how a corporation actually raises money to get started. Section 2. Stock basics and authorized shares. When a corporation is formed, it gets permission from the government to issue a certain number of shares. This is called the authorized share capital. Think of it as the maximum number of ownership slices the corporation is allowed to create. But just because shares are authorized doesn't mean they're all sold right away. The shares that have actually been sold to investors are called issued shares. And within those, the shares currently held by outside investors are called outstanding shares. Some shares might be bought back by the company. Those are called treasury shares, and we'll come back to those. Now, there are two main types of stock. Common stock is the most familiar. Common shareholders get voting rights and may receive dividends, but they're last in line if the company shuts down. Preferred stock is a step up. Preferred shareholders get dividends first, and they have priority over common shareholders if the company is liquidated. But they usually don't get voting rights. When a corporation sells stock, the accounting entry records the cash received and increases the equity section of the balance sheet. There's typically a par value, a very small nominal value assigned to each share, and anything received above that goes into a separate account called additional paid-in capital or share premium. So if a company issues 1,000 shares with a par value of $1 each, but sells them for $10 each, the par value account gets $1,000, and the additional paid-in capital account gets $9,000. Total equity goes up by $10,000. But how does a company decide what to do with its profits once it starts making money? That's next. Section 3. Retained earnings and dividends. Here's where things get really interesting. Every time a corporation earns a profit, it has two choices: keep the money inside the business or send some of it back to shareholders. The profits kept inside the business are called retained earnings. This account grows every year the company is profitable, and it shrinks when the company pays out dividends or suffers a loss. Retained earnings represent the accumulated wealth that the corporation has built up over its lifetime and chosen to reinvest. Dividends are the portion of profits paid out to shareholders. And here's something a lot of people miss. Dividends are not an expense. They don't appear on the income statement at all. Instead, they reduce retained earnings directly. There's also an important sequence in the dividend process. First, the board of directors declares a dividend. That creates a liability on the balance sheet. The company now owes money to shareholders. Then, on the record date, the company identifies exactly who owns shares. And finally, on the payment date, the cash actually goes out the door and the liability is cleared. Preferred shareholders receive their dividends first. If a company has cumulative preferred stock, any missed dividends from previous years have to be paid before common shareholders see a single cent. That's a powerful protection for preferred investors. So now you understand how profits flow. But what happens when a corporation wants to buy back its own shares? That's where treasury stock comes in. And it's a concept that surprises most first-time accounting students. Section 4. Treasury stock. Treasury stock is stock that a corporation previously issued and then bought back from the market. Why would a company do this? Sometimes it's to increase the value of remaining shares. Sometimes it's to use the shares later for employee compensation plans. Whatever the reason, the accounting is unique. When a company buys back its own shares, it records the treasury stock at cost, meaning whatever it paid to repurchase them. This treasury stock is recorded as a negative number inside the equity section of the balance sheet. It reduces total equity. Here's the key thing to understand. Treasury shares are not an asset. The company does not own a piece of itself. These shares simply reduce the amount of equity available to outside shareholders. If the company later reissues those treasury shares at a higher price than it paid, the difference goes into additional paid-in capital, not retained earnings. There's no gain or loss on the income statement for treasury stock transactions. This is one of those rules that trips up a lot of students on exams. Now let's put everything together and look at how the equity section of a corporate balance sheet is structured, because once you can read it fluently, financial statements stop feeling intimidating. Section 5. Reading the stockholders' equity section. The equity section of a corporate balance sheet is like a scorecard of the company's ownership history. It tells you how much money came in from investors, how much profit has been saved up, and how much stock has been bought back. A typical stockholders' equity section has 4 components. First, common stock at par value. Second, additional paid-in capital, the amount received above par. Third, retained earnings, the accumulated profits kept in the business. And fourth, treasury stock, shown as a deduction. Add the first 2 together, and you get total contributed capital. Add retained earnings, and you have the total before treasury stock. Then subtract treasury stock, and you arrive at total stockholders' equity. That final number tells you exactly what the shareholders collectively own after all the liabilities are paid. Understanding this section helps you evaluate whether a company is growing, whether it's been rewarding shareholders, and whether management has been repurchasing shares aggressively. It's a goldmine of information once you know how to read it. Wrap up and call to action. All right, let's bring it all home. Corporations are unique because they separate ownership from the business itself, giving investors limited liability and making it easy to transfer shares. Stock issuance raises capital and builds the equity section. Retained earnings capture profits kept in the business, while dividends distribute profits to shareholders. Treasury stock reduces equity when a company buys back its own shares. And the stockholders' equity section ties all of it together on the balance sheet. If any part of this clicked for you today, hit that like button. It genuinely helps this channel reach more students who need it. Subscribe so you don't miss the next video, where we go deep into earnings per share and how investors use it to evaluate stocks. And drop a comment below with your biggest question about corporation accounting. I read every single one, and your question might become the next video topic. See you in the next one.